let's get started. Let's dive in. If you could put up the Approved Guy site. All right, so this is my website, theapprovedguy.com, and scroll down a little. And on the site, you can see all of the different topics that I discuss and I teach on my channel. Everything from starting a business, getting business funding, building business credit, personal credit, debt management, velocity banking, infinite banking, asset protection, retirement planning, generational wealth, kingdom principles. So these are all the topics that are kind of merged together in what the Approved Guy brings to the table. Okay. Now, as I told you when I started, I'm the director of financing for OrangeFi, and a division of OrangeFi is Business Credit 101. We started about 4 years ago. Teaching business credit. OrangeFi has been providing funding for about 10 years, okay? The reason we started teaching business credit is because we started having many business owners in business for 10, 15, 20 years doing millions of dollars in revenue, and they're expecting, they're not asking, they're demanding to get approved for funding with no personal guarantee. Who wants to get approved for funding with no personal guarantee? Does everybody know what a personal guarantee is? Exactly. So your personal guarantee means that you are personally signing that you are liable for the debt. It's your personal guarantee, right? So anytime you buy pretty much anything, it's going on your personal guarantee, right? Now your business has an EIN number. Everybody have an EIN number here, right? That has a business, yeah? All right, so your EIN number is essentially your business's social security number. That's what it is, right? So that means that the business itself can have its own credit. But just like personal credit, it doesn't happen automatically. It takes a little bit of time, and it takes a little bit more intentionality and commitment to building the business credit. Okay, so there's some preliminary steps which we're going to go over today, as far as how do you know, what are the first steps to building your business credit before you actually start, and then what do you do next. Now, I find that it's very important that you understand the limitations of what you can and cannot do. Okay, so like I said, you know, business owners demanding 10, 15, 20 years, millions of dollars in revenue. Now think about it. You've been in business for 10 plus years, right? And you know, you're generating monthly $150,000, $200,000 a month. And you call a bank and you're like, hey, look at all this tenure, look at all this time. I want to get this loan. I don't want to use my personal credit. And they're like, no, sorry, sir or ma'am, you're going to have to personally guarantee that. So that could be very frustrating because it's like, wait a minute, I'm a business owner. Why can't I get it on my business credit, right? So the problem is, the truth is, it doesn't matter if you're 15, 20 years in business or if you are brand spanking new, a startup. You have to start at the same place as far as the building of the business credit. Now, the longer you're in business, that definitely adds value because you have tenure. The longer you're in business, you have history, right? And of course, if your business is performing, you have revenue and you can show tax returns. So that's going to open up more and more funding options for you as you go. But there are funding options for startups. There's funding options for you after a year to 2 years. After 2 years, that's when the floodgates open as far as pretty much all the options are concerned, but there are options in between, right? The building of the business credit takes time, okay? So when you're building, or if you're starting off with personal credit, right? Who here has personal credit? Who here has credit cards? Right, okay. Who here, when they first applied for their first credit card, got a $10,000 credit card? You got a $10,000 credit card on your very first credit card?
Oh, the first one.
Yeah, okay. I'm talking about the very first one. The first credit card you ever got? Okay, so you might have had something called authorized users on your credit profile, maybe. You did, okay. And a signing partner. Okay, so that could do it, right? But if you're gonna do it organically on your own credit, 99.9% of us, we're gonna get approved for something small, like 100, 200, and then within a couple months, you can get an increase. A year later, that's gonna grow to 1,000. It could take several years before you get approved for 10,000, 15,000, right? There are some, strategic shortcuts that you could take, such as a co-signer or authorized users on your credit profile that strengthen your credit, and that can help you to get some bigger limits a little bit faster. But at the end of the day, when we're talking about pure organic credit, it takes time. It doesn't happen overnight, okay? So the same thing with business credit, right? Now, when you're starting to build business credit, it's very important that you understand the initial stages of the process is an investment in your business, okay? Too many people think that if you're building business credit, that means you're getting access to business funding. There's two different things, okay? Building business credit, if you build a house, that means or an office space, right? The construction, the foundation that takes place is a building process. But until that building process is done, nobody can enter the building. There's no exchange of goods until the building has been completed, right? So that's the difference. Building your business credit is setting the foundation, establishing the business credit, and then once you have the business credit, then you have the authority to then make some demands as far as what you can qualify for, okay? So in between that, you are accessing funding in increments as you're building your business credit, okay? So let's start with first understanding just a few key concepts, just so that we can cover the bases of funding, and then we're gonna get into these rules. So in my experience as a finance expert, there are 5 C's of financing. Forgive my handwriting. Can anybody tell me what they are? Anybody know? One is character, correct? And then somebody said collateral. Anybody else? Character. Yeah, I'll elaborate on each one. So that's going to be capital, but that's, yep. Conditions, the last one. And the last one, I want to make sure we're having it right. Character, capital, capacity, collateral, conditions. Character, collateral, capacity. Thank you. Okay, so character is credit. But it's also who you are. So, for example, on your personal credit, if your year of birth on TransUnion is 0, that goes against your character. You're going to get declined. I've seen it many times where people with 800 credit scores, they didn't know because a human being touched their credit report at one of the credit bureaus. The other 2 bureaus were fine, but one bureau has the year 0 or it has a misspelling of a name. These little things, not only will it get you declined, but it can throw up a fraud alert, which is even worse, okay? When it comes to your business, it's the same thing, right? So that has to do with your foundation and how you set up your business. So again, there's 2 types. There's personal credit, and then there's business credit. Okay? Now I'm also I'm gonna list for you guys as we go through this some of the different types of funding, and I'm gonna try to associate the different requirements to qualify for the different funding programs that are available so that you can understand how your business credit will impact your ability to get approved for funding, okay? Excuse me. All right, so collateral, okay, that's what you're gonna use to collateralize the loan. It could be equity in real estate, it could be an asset like a vehicle, it could be cash value in life insurance, it could be, you know, anything that the bank or lender accepts as collateral. Many times lenders wanna see an asset, okay? A gentleman the other day asked me, can you collateralize my receivables, future receivables? And the answer is yes, but not every bank is gonna do that. So some banks will accept receivables, okay? Which means your future, if you have contracts, the anticipated funding or invoices that are gonna be paid on those contracts, those are your receivables, right? And so that could be used as collateral, okay? So there's, you know, so if you have no collateral, and the bank or lender that you're looking at for the loan you're considering requires collateral, you can have excellent personal credit, you can have excellent business credit, but if you don't have the collateral requirement, sorry, you're not gonna get approved, right? So I will give you guys a little dime that, you know, is to note, and again, we're gonna talk about different types of loans. with SBA loans, everybody's familiar with SBA? Yeah? So they have what's called an SBA 7A and a 504. The 7A can be used for working capital and a whole list of things to give you 10-year terms at prime plus 2.75. You can get SBA loans as startups. I work with about 15 banks. They're all very different. Some of them will do loans as small as $25,000 up to $5 million, okay? Some of them require collateral, some of them don't. If you don't have collateral, you can bring an equity partner to the loan. You can. An equity partner does not have to be a partner or a member in your business. It could just be a third party who's willing to sign to offer their equity into your loan to collateralize it for you. So not many, I know most of us don't know somebody that's willing to do that, but maybe you do. Maybe it could be a friend or a family member or a business associate that might be willing to offer their equity for you to qualify for that loan. So just a little note as far as equity is concerned with an SBA loan. So that's collateral. Okay, we beat up on that one. So capital is going to be the money that you have for a deposit. So that's basically your cash on hand. Okay, so that's, in some cases, the banks will refer that as equity injection. Okay, what can you deposit into the loan? Okay, and so, some transactions might only require 3% or 10%. With SBA loans, typically they're going to look for a 10% deposit on the loan, typically. Okay, but that's the cash on hand. So again, you can meet certain criteria for certain types of funding. You can have good credit, personal good credit. You can have the business credit. But if you don't have the collateral, you might not qualify. If you don't have the capacity or the ability to make that deposit, you might not qualify. So again, it just depends what kind of loan are you looking at? What are you considering? Okay? The capacity, I just want to make sure I'm right, is your ability to pay back the loan. So on a personal level, that's going to be your debt to income ratio. Okay? Now you can kind of cheat your way through figuring out your business's debt to income ratio, but it's actually called your debt service coverage ratio, DSCR. Your DTI, debt to income ratio, you basically, to calculate that, you're going to take your debt, so just on the personal level, you're going to take your total monthly debt, minimum payments, whatever your total monthly debt minimum payments are, and you're going to divide that by your annual income, okay? That is going to give you a percentage, and that is your debt to income ratio, okay? So your total monthly debt obligations divided by your annual personal income is going to give you your debt to income ratio, okay? And most importantly, it's what's showing up on your credit report, right? So what's on the credit report, if it's there, it's going to be calculated into your debt to income ratio, okay? So you can more or less do the same thing for your business just by taking the business's monthly debts and then figuring based on the cash flow of the business annually, what is the business's DTI. The debt service coverage ratio is a little bit confusing and hard to explain, and it varies depending on the bank, how they come to that conclusion. Just make a note of debt service coverage ratio, and then I urge you just to research debt service coverage ratio. And these are questions that you want to ask the bank or the lender before you apply. What is your minimum debt service coverage ratio? How do you calculate that? Make note of that and then figure it out for yourself. What is your minimum debt to income ratio? For example, a lot of times with mortgages, it'll be around 40%. But along with term loans and lines of credit for your business, it's typically around 30%, right? If you have a lot of credit card debt and you need the ability to pay down that debt, maybe you want to get a bridge loan, a term loan to pay down the credit cards, right? They might accept up to 50%. And that might be a way for you to pay down your high balance credit cards, reduce your utilization so that your credit scores can increase, okay? I do want to make a statement about debt consolidation versus debt restructure, because a lot of people make the mistake and slip into doing debt consolidation. Everybody know what debt consolidation is, right? So what these debt consolidation companies do is they're attractive because they're going to reduce your monthly payments. Okay, the problem is what they're going to do is they're going to negotiate a settlement with the debtor, with the credit card company or whatever loans you have. They're going to negotiate a settlement. They're going to usually tell you not to make payment for a few months, which is going to cause you to go 30, 60, 90 days late on your credit. And then they're going to pay off that debt at a lower rate, a settled amount. And instead of, let's say you had 10 debts, 10 different credit cards, now you're going to have one bill, right, at a lower monthly payment. So your out-of-pocket monthly is reduced, which seems like a good idea. However, if you care about your credit, don't ever do that. Because what it's going to do, they're going to close all of those accounts. They're going to show up on your credit report as closed and settled for less than the original amount, okay? And what that does to your credit, it's going to tank it. And of course, it takes 7 years. Now, some people say, oh, well, I could just go through credit repair. Yeah, but no, not in this instance, because that transaction has been documented. The negotiation, the settlement, that payoff has been documented. You're not going to be able to get that off the credit report. So if you're considering a debt consolidation, you might want to consider a bankruptcy. It's going to be on your credit report for 3 years longer, because the bankruptcy stays on the credit report for 10 years, but at least you don't have to pay back the debt. But if in a debt consolidation, you still have to pay it back, just at a lower amount, and you're still going to destroy your credit. So just be aware, because some of these companies that are selling these products, they make it seem very friendly and attractive, but they're going to create another problem, which is you can't qualify for anything. All right, guys? So does anybody know what a UCC filing is? You don't know what a UCC? What is it?
Universal, I forgot that terminology, but basically you can go, that's when they report your debt to the bureau.
That is correct. Not to the bureaus, but to the Secretary of State. So this is also important to know. Oh, before I continue, I'm sorry. That last one right there, conditions, okay? That's basically your use of funds, okay? It's also the terms of the loan and the interest rate, right? Because if you're applying for an equipment loan or a truck loan, that is an asset. It's actually a lot easier to qualify for those types of loans than, let's say, working capital where it's unsecured, right? Because why? If you don't pay that truck loan or that equipment loan, they're going to come take that asset, right? But if you're applying for funding and there's no assets, there's no collateral, and you just want to have a line of credit, then the only thing you have is your personal guarantee, which means that it's a lot higher risk for the lender. So the conditions are going to be harder for you to get approved. So just understand that different types of loans are going to have different conditions. That's the last C, okay? So yeah, so a UCC filing is important to know and understand. What it is, it's the Universal Commercial Code. So whenever you apply for a loan, if you ever got an EIDL loan from the SBA during the pandemic, or a PPP loan, if you get a cash, and 99% of the loans that you might get approved for, they're going to put a UCC filing, okay? And usually it's in fine print, and they're not going to tell you. So what that means is they file the loan with the Secretary of State. And so now it's easy for them to put it on the Secretary of State, but 99% of these lenders do not care about removing it from the Secretary of State. So I'll give you an example, a story. I had a client last year. She was trying to get approved for an SBA 7A loan to expand her home health care company. She's in New York. And she had about 4 cash advances, right? It was killing her. So part of what we did is we did a debt restructure on the SBA loan, took those cash advances, put it into a 10-year term at prime plus 2.75. But her loan was delayed for almost 3 months because of those UCC filings. And she had 2 UCC filings from years prior that she didn't even know were on her credit report. The lenders were no longer even open. So she had to hire an attorney who had to go down to the Secretary of State and prove to the Secretary of State that those UCC filings were satisfied, and to get them off the credit report. Okay, so a UCC filing, there's a blanket UCC filing, which means it's like a tax lien against all of your business assets. Okay, so when you're applying for a loan, you want to ask, are you going to be putting a UCC filing on the Secretary of State against my business? And you can ask that instead of putting a blanket UCC filing, that they put maybe a partial UCC filing, maybe on certain assets like your equipment or furniture and fixtures, so you can limit your exposure. Why? Not only is it a pain in the butt to get it off of the Secretary of State, but later, when you go to apply for a better loan, you want to get more money, if that UCC filing is there, it could cause you to get declined or delay the process dramatically. So you want to make sure you talk about that, ask about that, and if there is going to be UCC filing, when you pay that loan off, you want to demand a letter from the bank, from the lender, to remove that UCC filing. Very important, so that you're not delayed later on, okay? All right, who here knows what compound interest is, compounding interest?
Interest rates on top of the money you invested.
That's right. So that could be your best friend or your worst enemy, right? So if you have debt and it's compounding interest against you, it's just going to kill you. Unfortunately, that's what happens with credit cards, which is why you don't want to carry high credit card balances and just pay that minimum payment, because you're never going to pay it off because it's compounding interest. You end up paying a lot more for that debt, right? However, if you can flip the script and you can receive compound interest coming back to you, right, then that's a win, and that's what we want to be able to do, right? I have created a term, I haven't seen anyone use it, called compound credit. And let me break that down. Now, compound credit is what happens when you use credit wisely, meaning you leverage credit, right? Because if you don't use credit wisely, it becomes your worst enemy, compound interest against you. But if you use credit properly, credit cards in particular, you'll start to experience what's called the compound credit effect, right? What's going to happen is you're going to start getting limit increases. You're going to start getting offers for 0% interest promotion credit cards. That's going to be both on the personal and on the business. You can leverage that credit, and the key is not to let the debt sit with payments. You want to only use the credit as a way to pay what you could afford to pay and immediately pay it right back. Does that make sense? Right? There's another component of these credit cards, which are rewards points, cash back, travel points. So if you leverage the credit properly, I'm kind of getting my head of myself. I'm starting to get into velocity banking, okay? But it applies here as what we're talking about in terms of business credit and credit, because if you understand credit and how it works, you can start leveraging the credit, gaining the cash back, gaining the rewards, and you start getting bigger and bigger approvals and bigger limits. Excuse me. A lot of us are afraid of credit cards, are afraid of debt. If you use debt properly, it can be your best friend. It can be a form of currency that will allow you to leverage, to grow, to do things you couldn't do otherwise. Okay, and I'll give you some examples as we continue. Okay, finally, return on investment (ROI). I just want to say that you need to know what your ROI is. All right, and more importantly, you need to know when are you anticipating and expecting that ROI, which means that you need to have a business plan. I talk to so many business owners that don't have a business plan, okay? On my channel, you'll see it when you go there. There's a product, it's called Live Plan. It's $15 a month. This is the simplest solution that I have found to build a business plan. It literally leads you step by step, just through a Q&A, and it builds a professional business plan for you. I've had clients get approved for SBA loans using Life Plan. Now, I also have a resource that I can refer you to. Her name is Ashley Cheeks, and she is on the Forbes Business Council, and she charges $8,000 for a business plan, right? So when you're ready to level up and you want to, take it to the next level, if you're looking for equity investors or angel investors, then you need to talk to Ashley. But if you're getting started and you're on a budget, check out Life Plan.